It was only a matter of time before Apple issued a credit card. This move is an example of a market trend known as financialisation. It describes the rise of finance and financially oriented behavior throughout our economy, and it's been a driving force in the global economy for several decades. But now that we've reached what I call peak Wall Street, there will be diminishing returns for companies that choose to focus more on markets than the real economy. Look at Kraft Heinz, the packaged foods group partially owned and run by Brazilian private equity group 3G. The latter has been accused of avoiding longer-term investment while employing short-term financial tricks, such as paying suppliers late in order to improve free cash flow. And the former has lost more than half its equity value since its creation in a 2015 merger. Then there's the U.S. shale industry. Activist investors have been swarming thanks to an overexpansion funded by investors seeking higher yields. The energy bond market has tripled in the past decade, but much of the money has funded higher executive salaries and an output glut. Debt-laden companies are now ripe for forced consolidation by private equity and other investors. The multi-year explosion in share buybacks also reflects the trend. Most companies are buying back shares not as a vote of self-confidence in their own future, but as a way to boost their share prices. The result? Total financial assets are now more than triple the size of the real economy. The corporate bond market is now worth $13 trillion, twice as much as in 2008. Yes, debt is the lifeblood of finance, but it's also the biggest indicator of future crises. Financialization has risen for nearly 5 decades now, but like much else in the markets today, it seems ripe for a correction.